Okay, it looks like the cockpit is telling me that we have an excellent connection. So looks like things are good to go. I see that Plant One has already said hello, which is fantastic. Always a pleasure, mate. I feel like this is maybe the 7th or 8th time, maybe even more, probably even more than that, that you've come along to one of these live sessions. So it's great to have you back, mate. Gilly Monster, Pinch Punch, first day of the month. Welcome to November. Indeed, mate. It is the first day of the month. So yeah, November. We close the door in October. October is a great month, I must say. But here we are, November, and in Melbourne right now, it's beautiful weather today. I don't know if anyone here is from Melbourne, but yeah, it's wonderful. I think Rob's just said g'day. So I'm joined by Rob today. Rob's on the other side of the mic as well. So if you're chatting to us, it could be either Rob or I that responds to you. Good morning, Amit. Wonderful. Yes. Good morning. Good afternoon. Never mind. Whichever one. I don't know where you're coming from. So you could be in Perth and you could be joining us early. But here it's just struck afternoon. And so today we're talking about a whole heap of stuff. We're talking about ETF investing, and we're talking about how that relates to ethical investing, ESG investing, responsible investing, all of these different types of things that are kind of becoming very prevalent in our society now, not just as investors, but we also see it kind of pervading the other parts of our lives as well. Jonesy says, hi, Owen. We're free and have good weather at last. Yes, indeed. I hope you had a great weekend, mate. If you're in Melbourne like I am, then tomorrow you also get a public holiday. Well, some people do. Many small businesses like my own do not. So today we're talking ethical investing. We're talking about ETFs in particular and how you can use ETFs to do that. This is a really important topic, and it's a topic that I talk about a lot because everyone is coming to me and basically asking, how can I invest according to my values? And as you'll discover in this session, basically what we're talking about is how you can define what your values are and how you can invest in such a way. And a huge shout out, a special shout out to the team at SelfWealth for bringing free ETF buys until 2022. So the team has decided that a great way to get people involved in investing, and in particular in ETFs, which we know are fantastic for beginners and advanced investors, is to enable them to buy the ETFs for free until the end of the year. So if you are thinking about buying ETFs, investing in ETFs, now is the time to consider that because you get free trading. So that's wonderful. It applies to the buy only. It does not apply to the sell. So if you decide to sell, that I'm guessing will incur a trade fee. So you want to keep a hold of the ETFs in your SelfWealth account. And ETFs are great for this because you typically buy them once, you buy them properly, and then you can just dollar cost average into them over time. So please, as always, fire away with any questions. I particularly like the hard ones. I got stumped with one last week or the week before, and I had to get the help of the community. So please jump back in, help each other out. And what I might do to start things off is I thought I'd maybe just start off an ethical investing, an ETF investing session with a very controversial question, which is basically, are bank shares an ethical investment? So tell me what you think. Remember, we're going to talk responsibly about investing today. So there's going to be it's going to be very polite, open, honest debate. But do you think that investing in banks is an ethical investment? And as we go through, we'll discover which ETFs invest in banks, which don't, and kind of their different, I guess, policies around that. So let us know what you think. Gilly Monster's coming from Gippsland, who says it is a glorious day down in Gippsland. Well, I hope it is, mate. I hope it is indeed, before we come to the heat of summer. Okay, so we're going to talk about what is an ETF. We're going to talk about how you can use them. We're going to talk about ESG, and then we're going to talk about the most popular ethical ETFs currently available on the ASX. I have previously recommended one of these to one of our members, so you'll get a interesting conversation around that ETF in particular, and I'll show you how you can invest in this ETF and actually save money, which is a fascinating thing. So I guess the other things we need to consider is, one, that any of the questions that I do answer are limited to general financial advice only. I don't know your personal situation, so I can't give you personal financial advice. I think some of the best questions that we get coming through are the kind of the hard-hitting kind of technical investing questions. If you have some of those, drop them into the chat. But if you have a support question or account-related query, head over to selfwealth.com.au and hit the live support widget there in the corner, and one of the team will sort you out. As always, my name's Owen Rask. I'm the founder of Rask Australia. I'm an analyst by day, podcast host, and I love doing educational sessions similar to this one. So I just love getting out and talking to investors. And, someone asked me the other day, another investor asked me, said, I get really nervous when I go up on stage and people ask me questions. I think it's that kind of imposter syndrome thing. And he said, what do you think? And I said, I love it. I love it when we talk about things. I love it when people get passionate about investing. So please, fire away with your questions. Let's have a great hour talking about investing. Okay, so first of all, let's just talk about, for those of you that may be new to investing, and I know there are many users that are new to investing, more investors than ever before have approached the share market for the first time in the past 2 years. COVID plus money plus being locked up at home, all of these different things combined has meant that people effectively want to invest. And we've seen things like, the rise of getting the SelfWealth app on your phone and being able to invest that way is a totally new experience for so many people, and opens up new markets. So what are ETFs? ETFs are just baskets of shares or something else inside them. So instead of when you buy, an individual share, you buy one share like Telstra, that goes into your portfolio and you have one single exposure. With an ETF, you can have hundreds of shares or hundreds of bonds or whatever it is, gold, it could be anything inside the ETF. Think of it like a wrapper or like a basket, and you buy the basket. We're actually going to find out today that there are things called diversified ETFs. So instead of buying a basket, you buy a basket of baskets. So you buy one investment and it invests in other ETFs. And so we can go on and go on and go on like this. We're going to find out all the different types of ETFs that are put together on the ASX for us in today's session. So that's the kind of, what is an ETF? It's a basket. It's like, instead of going to the store and you pick out all the ingredients, flour, eggs, milk, and all of that to make your meal, someone does it for you and they just give you the box, kind of like a HelloFresh. They just give you the box of ingredients and say, here, buy the box. Don't buy the individual ingredients, buy the box. That's what an ETF is. Okay, so what are, we actually had a comment in here already from Amit who says, define ethical, exclamation mark, multiplied by 4. So that is something that we're going to do in just a moment. We're going to define ethical. We're going to define what that means, because what is ethical for you is not what's ethical for me necessarily. So when it comes to ETF investing, just some final primers here. The things that we look for in ETFs, we look for exposure. So what is it actually invested in? Some ETFs invest in things like bonds, gold. You can buy US dollar ETFs, so an ETF that invests in US currency, and you can invest in that. You can invest in overseas shares. You can invest in Australian bonds, global bonds, all different types of stuff through ETF structures. And the simple thing that you need to know is that you need a brokerage account to do that, just like SelfWealth. So you need the brokerage account in order to buy the ETFs. That's basically all there is to it. The fees and costs. So normally when you trade on the SelfWealth platform, you would pay a fee, a very low fee, but you would pay a fee. And typically what happens is that's the brokerage fee that goes to the broker. So in this case, we'll go to SelfWealth. But for an ETF, when you buy into an ETF, you also pay a management fee. And the management fee, often called the MER, is disclosed on the PDS and often on the website of the ETF provider. That's taken out daily and it's taken out automatically. So you don't have to worry about that, giving someone some cash or clicking a button to say pay now. There's no bill sent to you. It's automatically deducted from your investment. The third thing to note is that we want ETF issuers, the issuers behind the ETFs, the companies that are responsible for providing that ETF, to be reputable ETF providers. Why? Just because then you have the kind of peace of mind of knowing that it's a trusted fund manager on the other side of the transaction. And fourth thing that we should be looking for when we invest in ETFs is basically having balance in our portfolio. So how does the new ETF that we want to purchase match up with everything that we already have in our portfolio and our risk profile and our tolerance? So for example, if we had 70% of our money invested in shares and 30% in bonds, and we are a conservative investor, that's probably too aggressive. That much in shares is probably too much risk. for a conservative investor. So a conservative investor then shouldn't go and add another shares ETF. They might invest in a bond ETF instead, and we get that portfolio back into balance. So we want to have balance, and we want to know when we're rebalancing the portfolio. Okay, so that's ETFs. So Gilly Monster, to my question, my very provocative question earlier on, which asks, are bank shares ethical? Is it ethical to invest in an ETF into a bank share? Gilly Monster says banks are marginal depending on your definition. Good that they're dropping fossil fuels, but many still have other dodgy areas. Christos asks, what is a reasonable management fee to pay for an ETF? And that's a fantastic question. So what is that yearly fee that I just spoke about? What is a reasonable fee? I think it depends on what type of exposure you want to get. So for example, if there were two ETFs doing exactly the same thing, choose the one with the lower fee. It makes sense. If there are two ETFs that do two different things, so if we're comparing oranges to apples, you can't say that the apple is worth this much and the orange is overvalued based on what the apple is priced at. And so when we look at this, some investors think, okay, well, I'm going to invest in the BetaShares E200 ETF. That's the E200. That's how you can find it. We'll jump over. So let's jump over screen. So people say, I'm going to invest in the E200 ETF here. And because the ETF has such a low fee, therefore it's better than the IVV ETF, which is another ETF that invests in shares. But the IVV ETF doesn't invest in Australian shares. The IVV ETF invests in US shares, whereas the E200 ETF invests in Australian shares. So we've got to consider what's most appropriate for that particular ETF. So I'll get out of this one. So the answer to that question, Christos, is basically it depends. I would say for an Australian shares ETF, just like a normal vanilla ETF, I wouldn't pay more than, say, 30 basis points or 0.3% per year. I don't think you need to pay more than that for just a normal Australian shares ETF. However, if you wanted to invest in something that's more thematic, which is what we call a thematic ETF, which is where it doesn't invest in just a normal way, let's say something like the Moat ETF. This is one that I own, guys. I think I've talked about this in the past. This is a Moat ETF that invests in US shares. So it invests not just on, when I say normal, what do I mean by normal ETF? A normal ETF, in my opinion, is an index fund ETF. An ETF that just tracks the index, like the ASX 200 or the S&P 500 in the case of IVV. But sometimes you can have ETFs focused on something different. And so in the case of Moat here, Moat is actually made up of shares that have been researched by analysts. And that's what you get in the portfolio, is you get the analyst's best stock ideas in one portfolio. And it's similar to the way if we talked about the SelfWealth ETF, if I can spell correctly. So if we talk about the SelfWealth Smsf Leaders ETF, this is an ETF that's based on what the community here at SelfWealth have defined as investments. And this is what I would call a different ETF because it's not comparable to, say, A200. Yeah, Demodern Da Vinci, welcome back, says Moat and Goat. Yeah, so Goat is the other one from VanEck. So just a quick pointer here, guys. Anytime that you see an ETF name and you see it and it looks a bit long and convoluted, you see this thing at the start here, that's the name of the provider. And typically everything else that you see after that describes what the ETF does. Or in this case, Morningstar provides the index that the ETF tracks. So VanEck puts together the ETF, Morningstar puts together the index, and therefore it is called the VanEck Morningstar International Wide Mode ETF. So that's GOAT here. Okay, so let's dive into, I guess, well, actually just one quick thing is why would you invest in an ETF? And so if you're thinking about, okay, SelfWealth's got free trades between now, or free buys between now and the end of the year, why would I consider using an ETF? And so if we come into our portfolio here, this is the watch list that we've been putting together over the previous few weeks. You'll remember that we talked about companies like Apple, Atomos in that very first session. We've talked about the Moat ETF before. We've talked about Sol Pattinson for dividend income, Zero for growth and for trying to identify those inflection points. But imagine this is your portfolio, right? Here we can see that we have maybe, I don't know, 20 shares in the portfolio. This imaginary portfolio. It's actually just a watch list, but you get the idea. If you have 20 positions, then how do you kind of start to manage them? Like, how do you keep up to date? How do you do all these types of things? So eventually some investors, what they do is they start to say, hey, I'm not going to keep buying individual shares. I'm going to start introducing some ETFs because I know that they're easier to manage. So we can just invest in the ETF and kind of build that core exposure, whether that's to shares in Australia or shares globally, and then we build around the outside. This is what we call a core and satellite position exposure. So what we have is a very strong core in the middle, and then around the outside, we have individual stock ideas. So this is the way I invest personally. So this is the way I use ETFs to build and to dollar cost average into the stock market over the long term, and then I buy individual stocks around the outside. That's the way I invest. And so, for example, I own Apple shares, but I also own the MO ETF. I also own the E200 ETF, which we spoke about before. And so this is the way I choose to build my portfolio, because then I can have low cost, easy to manage ETFs at the center, and then around the outside, I have all of these individual exposures. And I think predominantly that's what we'll see from investors globally over the next 10 to 20 years. I think many investors will opt for ETFs because they're low maintenance, and then also use shares and buy the best shares they can find. So I've had some great questions come through already. How does buying shares in an ethical company or an ESG ETF on the secondary market support that company or companies? That's from Daniel Mack. Great question, Daniel. This is arguably the #1 criticism of ethical investing in Australia. So what I might show you, Daniel, is I might show you a company. Let's say that's probably a bad example. Let's say we have Australian Ethical. Australian Ethical is a fund manager listed on the Australian Stock Exchange. Now, Australian Ethical has performed exceptionally well in recent times. I've been following this company for years, and every time, Daniel, I've said, oh, it's so expensive. I would never buy shares in Australian Ethical. How expensive is it? How expensive is it? And look what it's done. Every time I've said it's expensive, it's basically gone in the opposite direction. So it's a really interesting thing, right? So here we've got this ethical company, this company that's focused on ethical investing, and it's kind of just growing and growing and growing, right? So people want to invest in it. And if we come down through the, where are we? If we look in the ratios here, and then we go down to valuation, and if we look at the price to sales ratio, Daniel, here we'll see it has a price to sales ratio of 26 times. So what that is comparing is the price or the value of the company against the yearly sales. 26 is very high. 26 is almost like it's a software company. And so what is one of the reasons why its valuation is so high? The first reason is, it's obviously growing very fast. Over the past 5 years, it's up 20 to 21% compounded per year in revenue. So its revenue is growing very stable and very quickly over that time. So now I want you to imagine, Daniel, that instead of it being called Australian Ethical Investment, all right, Daniel, I want you to imagine that it's called Australian Unethical Investment. So all of a sudden, we have Australian Ethical here trading at 26 times its sales. So the sales that it makes this year, the value that investors are willing to put on that is 26 times. That's what they believe. That's what the market believes is a valuation for this company. But if we change the name to Australian Unethical Investment, wouldn't that be a bit of a turnaround? I would be willing to bet that many of its investors, many of Australian Ethical's investors, would sell the shares because it does not align with their values and their beliefs. And so what I think happens when you buy an investment in this part of the market, so when you buy an investment, say you buy, I don't know, you buy Magellan instead of Australian Ethical, I think what happens is, and this is where it's hard for investors to kind of understand this is in a way, is I think what happens is it drives up the valuations of companies that are considered to be ethical, and there's a kind of this indirect effect of companies that are more unethical, we could say, they tend to get a lower valuation. And so eventually, well, what impact does that have? Let's say that Australian Ethical wants to sell some of its shares to make an acquisition. If Australian Ethical sells some of its shares on the stock market, it will then have to sell them at the current or around about the current price. So what's the current price? It's $13. But if it was Australian unethical investment, then it might have to sell its shares, if the share price fell, to say $6, it would have to sell shares at $6. So then what happens is the company that has the higher share price and the higher valuation can actually raise capital by selling shares into new investors, and it can get more value for the same amount of shares or the same price. So let's say we had a share price of $13 and Australian Ethical wanted to raise $100 million from new investors, or 137, let's say that. It would have to issue 10 million shares at $13 each to get $130 million. But if we had a share price of $6, then it would have to issue twice as many, more than 20 million shares, just to get the same amount of money into its business. So what happens is, if there are more investors who want to invest ethically, it drives up the share prices of companies that are doing the right thing, at least in their eyes. And so then all of a sudden, you come up to a point where companies that are more ethical have better access to funding and have better access to getting talent, have more influence on investors and the market generally speaking, and so on and so forth. So that takes a very long time. The other thing is, and this is one final thing, Daniel, that I'll add on to why ethical investing is working, is that if you have enough of these investors, say, that care about where their money is going, what actually happens is, if you invest in a super fund, so let's say you invest with Australian Super, and you invest, and that company invests in, and I'm just going to use an example because this is a very polarizing one. An Australian Super invests in Whitehaven Coal, and most of its members at Australian Super say, hey, that's not a very ethical investment for whatever reason, right? Then all of a sudden that puts pressure on Australian Super to sell their position in Whitehaven, or to ask the Whitehaven board to start reporting on their greenhouse gas emissions and so on and so forth. And eventually that pressure that we put on our investment firms puts pressure on the companies, which then puts pressure onto renewable sources of energy, renewable packaging, and so on and so forth. So that's basically how it works. And so that's a very common question, Daniel. How does it actually impact? Well, it doesn't impact directly. If I go and buy Whitehaven coal shares right now, if I was to click buy right here in my SelfWealth account, it wouldn't necessarily make a difference. So yeah, very interesting. And I once interviewed a fund manager from the UK, and he came out to Australia and was a really, really top performing fund manager, and he had exceptional performance, right? And he came to Australia, and we said to him, are you worried that 50% of your portfolio is in tobacco? And he said, no. Why would I be? And I said, well, it doesn't seem like a very ethical thing in the current landscape. And he said, well, that's only an Australian thing. If you go back and you go overseas, it's not real, smoking's not as frowned upon. And I said, oh, well, that's interesting. And so his take was that, as an investor who thinks that tobacco companies are more ethical than, say, someone else would, then all of a sudden he can get better valuations for the companies. And so that's how he performs. And so this company here, this company is called Altria. I don't know if anyone's heard of this, but Altria is basically one of the world's biggest tobacco companies. And this company, it's struggled a little bit recently, but if you go back long enough into Altria's performance, you will see that it's actually performed exceptionally well over a very, very long time. So something really, really interesting. Serge has just said, no sound. I hope you can hear me, Serge. I think everyone else can hear me. Just want to confirm that everyone else can hear me. If not, you may have the YouTube player on mute there, Serge. Okay, so there's some questions that come in here. Wonderful questions. Gilly Monster says, the Intelligent Investor Ethical ETF tracked well this year. Yeah, so Intelligent Investor basically come out and launched their own version of an ethical fund. Keep in mind, it's probably, even though it looks like an ETF, it sounds like an ETF, and it smells like an ETF, it may not be an ETF. Gilly Monster. It may just be a listed fund, or it may be an actively managed ETF. And that's perfectly okay, but it's probably a little bit different to what most investors are looking at today. So it's really interesting. I've actually got a list of ethical ETFs here. These are the ETFs from Australia, and we can see the kind of the biggest ETFs in Australia in order. This is using past data from July. Is the ETHI ETF, the FAIR ETF, the VESG ETF, the VETH ETF, the G Bond ETF, GBND, HETH, Earth ETF, CLNE ETF, E200 ETF, and the list goes on. So the INES ETF doesn't rank in the top 10, Gilly, but it's definitely one to keep an eye on. Yeah, all good. Thanks, everyone. So Jacinta, you've asked, Jacinta, will the entire episode be available to watch online? Yes, absolutely. Just hit that big red button that normally says subscribe to SelfWealth YouTube, and you're good to go. Thanks, Rob, for saying it's audio is all good. Okay, so there's some. So that's the first thing there, Gilly, is we're looking at some of the biggest ETFs here today, and we're looking at these ones right here. Now, I just want to switch gears a bit, and I want to show you something else that I put together, which is where is it? This one right here. So this is just taken from one of the courses that I've created on our website, and I don't know if you can see it. We'll get rid of this thing. You can't really see it because it's kind of on its side here, but basically this shows you how, when we talk about ESG investing, we're talking about environment, social, and governance, ESG. The biggest one that people talk about is the E. There was a webinar recently from the SelfWealth team. Maybe, Rob, you can chuck that in the chat for us. There was a webinar on the impacts of ESG. And one of the things that you will remember that we talked about recently is we talked about, if you come into any of the company pages here on SelfWealth and you scroll down, you'll see on the right-hand side here, SelfWealth has this really cool widget that shows you, based on ESG criteria, what may be considered ethical and what may be considered unethical based on a range of features. So this is available on the SelfWealth website. Daniel Max says, thanks. No worries, mate. Absolutely. I hope that answered your question. Okay, so we've got the with SelfWealth. Sorry, Rob's just put in the webinar link there. Rob got the guys on to talk about what is ESG and how does this widget work. But this is a really cool feature. Okay, so basically the way it works with ESG investing is companies are graded across 3 key metrics. So they're graded across environmental, social, and governance. And so we look at things, but through those 3 lenses, if you like. And the one that people always think of when they think of ESG or ethical investing is the environmental component. But the environmental component is only one part of the overall pie. So environmental means things like, how does the company respect its plants, its environment, it's all of the things around us. Does it consume paper? Does it, instead of going paperless, all these types of things. Social includes all different types of stuff, and we can see it here. How does the company go for workforce and getting a staff for workforce? Does it have a really engaged workforce? Human rights violations. Many of the big consumer companies we know that work in parts of Asia or Africa may be involved in sweatshops and different types of kind of really poor quality working environments. Community score, does the company give back, or does it have an impact, a negative impact on society? Governance, this is the big one that I spend a lot of my time on as an investor, is how do I rate management? Do I believe management has integrity? Do I believe management is aligned? Do they have an independent board of directors? All of these different things. So if we come back into, where is it? This one right here. What this actually shows, we'll go back a bit. What this actually shows, and I'm sorry if it's a bit small for you, but I'll just kind of paraphrase it. It basically shows you that if we're focused on the E in ESG, we tend to look at things like carbon emissions. So we look at things like, is the company involved in greenhouse gas emissions? Does it produce fossil fuels, if that's the case, or is it involved in clean energy and these types of things? And I'll show you how this relates to ETFs in just a second. But if you look at all of the different widgets on this thing, green obviously shows you the positive impact your carbon can have. So for example, if you wash clothes in cold water around your house every year, that has a 0.44 tons of carbon impact on the environment. So 0.44. But if we jump across to energy and you choose to buy your energy from renewable sources, that has a 1.43 tons impact every year. So if you think about it in one way, it's almost 3 times more efficient to choose a clean or renewable energy source than it is to just wash in cold water. So this is just from this is based on a number of assumptions that we made when we did this chart, but it also comes from super funds and the like. If we cross right across again, we can see the things that you eat. Eat a plant-based diet, and that can have a 1.05 tons impact. So meaning if you eat, a non-meat diet, why? Because meat has an impact on the environment. If we go across again, and I might just jump straight to the end here rather than kind of laboring on this point. But if we jump to investing right here on the right-hand side, it says choose a high-impact, ethical, so sustainable option as your investments. And this has up to 7 tons of annual carbon positive impact on the environment. Go vegan, says Chris. Yeah, well, you could. The way I frame this, Chris, is not to say go and eat plants. It's actually to say, if you choose an ethical investment option, in your super fund, that's 7 times more effective than one person eating a vegan diet. That's the way I think about these things, just kind of that engineering brain, because you get 7 tons of positive impact just from choosing the highest kind of impact positive investment ESG strategy for your money. And so this is such a simple thing, right? Such a simple thing to do from your investments to have a positive impact. Now, if we come back in, and Jacinta's question was, where do you find this thing? You can go to any company page, Jacinta. So if we use the top search bar here, let's say we search for Tesla, which is a very popular stock. We just chuck the ticker code in there, come down, and we can see the ESG score on the side here. Yes, and Kwan, yes, absolutely says, but all of my discussion just there depends on how much you invest, and it's not an excuse not to do the other things. Absolutely, Kwan. So this is not your get out of jail free card. If everyone's thinking, I'm just going to invest in the ethical option and then I'm just going to go burn down a forest, that doesn't really, I guess, even out in the wash. So maybe just think about, you don't have to do just one. You should probably do a few of them, if I could be so facetious there. Okay, so some great feedback here, guys, in the group, just sharing with each other and just helping each other out, helping Jacinta out. So the way that we are more and more often measuring companies' performance for ESG criteria is basically here we look at, and I'm just going to be very quick because I want to move on to how we can actually invest in these things. The first thing is here, if we look on this page, and this comes from Plan A Academy, and what it actually shows you is you've probably heard of companies say, oh, our scope 1 emissions or scope 3 emissions. Like what the heck does that actually mean? Well, what we're doing here is we're actually looking at quantifying the impact we have on the E in ESG. And the way we do that is we have scope 1 emissions, and scope 1 emissions are basically, if you have a printer in your office or if you have an office facility that's very energy inefficient, well, that's your scope 1 emissions. If you have scope 2, that would be, where do you buy your electricity? Where do you kind of go for your heating and cooling? All of the things that you don't necessarily control, but you have an impact on. And scope 3 is, oh yes, you see this all the time from technology companies. We have wonderful scope 1 emissions. We're going to be carbon neutral by 2030 or something. But yet many of their server farms are run on the most inefficient forms of electricity. And so that doesn't really reconcile. So that's the scope 3. It's capturing everything that happens, not just in your business, but in the businesses that you use or the businesses that you sell to. So how do you influence those? And so this a good example would be, say Apple makes iPhones, but Apple relies on Taiwan Semiconductor or semiconductor manufacturing companies in Taiwan or overseas. So then Apple, to have scope 3 emissions, would have to have a positive impact and get those organizations in the supply line up to scratch as well to have good scope 3 emissions. So that's an example of how this kind of all comes together. And so Now, at the very beginning of this discussion, we talked about how Amit said, well, whose ethics are we talking about? And one of the things that I want to impress upon everyone that walks away from this session today is basically that you don't necessarily all have the same ethical values. For example, I am an investor in the E200 ETF. So the E200 ETF, ASX E200 BetaShares. We'll get the page up here. I'm an investor in this ETF, right? And this ETF invests in Commonwealth Bank of Australia. It invests in CSL. It invests in BHP. It invests in NAB and all these different things. And I'm here to say that I think I invest ethically, even though I own this thing. So you might say, well, banks aren't very, think of all the bad things that Westpac have done or whatever. You might say, okay, well, that's not a very ethical investment, Owen. But then someone else in the community might say, hey, I agree with Owen. That's quite ethical. And so the important thing to remember is that when we talk about ethical investing, it's based on your personal values. Ethical investing is very hard to quantify into a formula. We have ESG scores down here, but ethical investing is how does it sit with your personal values? Whereas, say, for example, sustainable investing, which we can measure thanks to carbon, we can measure, sustainability. That's probably different because we can measure that. But we can't say, oh, that's very ethical, that's unethical, because that's a very personal decision. So what I actually tell our investors and our members to do is I say, go away and actually write down on a piece of paper the industries, list the industries that you consider to be unethical and avoid those ones. But then on that same piece of paper, put down a list of industries or themes that are ethical and invest in those. And so what we have is you are avoiding something and you are deliberately targeting something. And so that is how I get to the bottom of basically what I define as ethical. Now, I might go ahead and sell the E200 ETF if I'd ever decide that I no longer want that ETF in my portfolio, because we're about to get to these ETFs. And so that is a really simple strategy, and it illustrates the point that ethical investing is to do with, how your values, and maybe sustainable investing is more to do with, can we measure it and is it actually a positive impact? And so that's a different thing altogether. Now, one of the criticisms that we have is, one of the criticisms that people have of ethical investing, and I can't believe we still have this conversation, quite frankly, but we do. And one of those things is, does ethical investing work? Does focusing on more things than just profit have an impact? And the reality is it does. This is the Responsible Investment Association of Australasia. So this is the RIAA. And they provide a framework for researching companies. And you'll find out in a minute that the BetaShares ETF, the Fair ETF, this one right here, and the ETHI ETF, this one right here, and the DZZF ETF, all of these ETFs have issued by BetaShares and have actually been, they've got a stamp of approval, if you like, from the RIAA. Now, the RIAA, when I did a survey of our students, actually, I found that the RIAA, people believe the RIAA is very important, but they don't say that the RIAA is the only thing that they want to trust or want to rely on. So if we come here and we go, say, Fair ETF. So if we come down, we can see that the RIAA has put their they've certified the BetaShares Fair ETF. So not all ETF have this stamp of approval, but this one does. So if we come down and we say, okay, well, is it positive to invest in a sustainable way or an ethical way? And what we actually find is that the funds or the fund managers who invest in a way that is considered responsible or ethical, it's responsible is kind of this umbrella term that talks about ethical investing, sustainable investing, impact investing, everything. And what we actually find is that over multiple time periods, funds that have some type of ethical bent to them tend to perform as well as or better than the stock market average. Now, this is not always the case. You can see here that some of them have underperformed. So this isn't like you put this stamp on the fund manager or the ETF, and then all of a sudden it's a better investment. That's not the way it works. This is just basically showing in clear terms how many of the funds outperform and how many don't versus the average. And there's another study that I found. Where is it? So there was another study that I found when I was putting together our course on this. There was a fund manager called AQR that said that companies that display superior corporate social responsibility characteristics had higher profit margins, better returns on assets, and achieved better growth. In the bond market, these same companies had lowest bond spreads, which is actually a really good thing. So this is one study that suggests that actually investing in ESG-focused companies and ESG-focused or considered funds actually has a positive impact. And so that goes back to Daniel's question from earlier on, that basically, does it actually work? Well, it seems to, and it seems to do it really well. And if we think about that, with all of the options on the market now, we can build a portfolio that, based on historical numbers, seems to perform better, seems to make us sleep better, and so on and so forth. So there are so many great ways to do this. How can we get started? Okay, we know that we've got the widget on the right-hand side here, but there is a really easy way to kind of just understand what ETFs do and which ones are kind of interesting. I'm going to go through them. And the thing to keep in mind is that what you get inside SelfWealth here, you can track the funds, you can see what other investors are buying, and you can just monitor the performance of your investment. Obviously, you can add them to your watch list. So we'll go ahead and do that now. We'll go into our watch list that we've created for the live sessions, and we'll put in the DZZF ETF. This is an ethical diversified ETF. One right here. We'll add another one. We'll go, say, the VESG ETF, the Vanguard ethical ETF. We'll add one more. So let's say ACD. Oh, we've already got ACDC. Let's try. How about? Oh, this is. Oh no, we'll go the E200 ETF. There we go. The Spider ethical ETF ASX 200 fund. Okay. So Anna Cayley says, do you focus on timing for ETFs the same way you do for individual shares, or just jump in when ready? Anna, obviously everyone's different in the way that they invest. For me personally, the way I think about ETFs is I've kind of got two drawers. If you think about it like you're in your bedroom, I've got my bottom drawer, which is ETFs. I don't really think about them that much, day to day. So I'm just happy just to put in my order in SelfWealth, and I would be putting in my order and saying, I'm just going to buy it at the price that I want to buy it at. So if I was, for example, looking at the E200 ETF, I might say put in a buy order for $24.15 and set that order for today. And just if it gets triggered, it gets triggered. But I typically, there is one difference, Anna. I typically place my orders for ETFs during the day. So when I put in my order to buy shares, I do that during the day. Whereas I don't do that with shares. And the simple reason is that when you go into the market every day, so let's say we come in here, for the E200 ETF, and we can see that the last share price was $24.15, and we can see that the offer price, the selling price, is $24.26, and whereas the bid price is $24.21. So what the offer price is, that is basically what someone's willing to sell you that ETF for, and the bid price is what's the highest bid currently in the market. So we might have to put in our offer at $24.26 in order to get the investment, because that's the seller's price. If we jump across to, say, a more liquid ETF, like the BetaShares A200, does that have depth? No. So what we can see here is we can see that the bid, the current buy order from the market is $124.57, and the current sell is $124.61. So that means there's a 4-cent difference, 4 cents difference here between these two numbers. So I'd want to put my order in at 124.61 or thereabouts. And whereas when I talk about shares, like if I wanted to buy Apple shares, for example, I would just put my order in and be happy to put that at market price. The reason that I do it with ETFs in that way is because I like to see the volume. I like to see where the buyers and sellers are during the day when I place my order. You can do that with shares too. That's just the way I prefer to do it with ETFs. So I've wasted way too much time talking about ethical investing. I want to start talking about some of my favorite ethical ETFs. Because remember, before the end of the year, SelfWealth has $0 trading. As you know, I don't work for SelfWealth. I come on here and I love doing these 60-minute sessions, but I'm a big fan of making it easier and educating people to invest. And you can do that. You can buy shares right now, buy ETFs, and you don't have to pay brokerage. So I think that's just totally awesome. Anyway, so here we go. Let's talk about some of the ethical ETFs that I have on my radar. The first one, and my favorite one of all, is the BetaShares Diversified Etfs. So they've got DZZF, they've also got I think it's Dbbf, BetaShares Diversified. Oh, if I can get this up, that's not working for me. So where are we? Here we go. Our funds, diversified. So BetaShares has 4 ETFs, Dbbf, DZZF, DGGF, and DHHF. And if we go over here, what we'll see is that these ETFs aren't on the current list of ETFs in Australia. They're not in the top 10. So none of those DZZF, Dbbf, none of them are in the top 10. Now, the reason for that is they're quite new. So many of these ETFs here at the top, these top 5, have been here for a while. But the DZZF ETF is actually quite new. So what does it do? Well, this is a really interesting thing, right? If we come over into BetaShares' website here and we find it, this is where I was saying it might be an opportunity to save money. So the DZZF ETF aims to invest, if I can make this bigger for you, you might be able to see it if you're on mobile, aims to invest 90% of the money inside the portfolio into growth assets and 10% into defensive assets. So this is like 90% into Australian shares and 10% into bonds. Now the Dbbf ETF, which is the slightly different one. If we go up, our funds, there we go, diversified, Dbbf. This is the same style of ETF, but it invests 50% in bonds and 50% in shares. Think about it that way. So we've got one that's slightly more aggressive and this one that's slightly more defensive. And so what they do is they invest in other ETFs that are ethical ETFs. So remember that basket analogy? This is basically like getting 3 boxes of HelloFresh, and all 3 boxes of HelloFresh delivered to you are ethical. So instead of trying to pick which ingredients, i.e. shares, and instead of trying to pick which box you're going to get that week from HelloFresh, you can just get 3 boxes and they're all ethical in one big box. And that's what we have here. So it's like a box of boxes, a basket of basket. You get the idea. So the Dbbf ETF has a yearly management fee of 0.39. The DZZ ETF is similar, I believe. So if we go back to that, the DZZF ETF, should have these numbers in front of me, sorry guys. This is a management fee of 0.39% as well. So why do I like these ETFs other than the fact that they're diversified? So other than the fact that they can, invest in multiple things in one go. And the reason why I wanted to put this on your watch list today is because if you look at this fee here, right, 0.39%, then you compare it to, say, the ethical ETFs, the fair ETFs. So if we go back to our list, remember ETHI and fair up the top here are the 2 biggest ethical ETFs in Australia right now, based on funds under management. That's this line right here. So those are the 2 biggest ones. Now, if we come down, if I was to buy the fair ETF today, I would pay 0.49%. So I'd be paying more to buy it this way, right? But the thing is, and here's the kind of punchline, guys. This ETF is included inside the DZZF ETF. It's also included inside Dbbf ETF. And the reason is, so just to confirm, if you wanted to buy the fair ETF, you can do that for 0.49. So you can pay for every year that you own it, you would have this fee deducted automatically. Or you could buy it inside the other one, inside the DZZF ETF, and you can get it for 0.39. So you can get it slightly cheaper. So this is why I think if I was going to invest in an ethical ETF, this would be one of the ones at the top of my menu, because it automatically invests in the other ETFs, which are already very good, but it does it for cheaper. So that's a very simplistic way to think about it. But if you want more information, you should go to the PDS, which is down the bottom. So you should go to that right down the bottom. Where is it? And you can find all of the information here. And it's the same on the Vanguard website as well. So Angel Kenworth asks, how do they deduct fees if you buy ETFs via SelfWealth? Well, so that's a very good question. How does an ETF like this, or even like the Vanguard Ethical Shares ETF, I believe it's called, this one right here, how do they deduct fees? Asks Angel Kenworth. And the way that they do it is, so when you see in your SelfWealth account, you see this fee, this share price right here. What actually happens is that tiny little fee that you see every year. So let's say the fee is 0.49% and you have $10,000 invested. That would be $49 a year. You know, if you have $10,000, it'd be $49 a year, almost $1 a day, right? On $10,000. That comes out of the price that you see here. So it's automatically adjusted for that. And so SelfWealth, you don't necessarily see it, but what happens behind the scenes is the ETF provider, i.e. BetaShares, deducts that from the investments that they're making on behalf of their investors. And so that's how that works. Anna asks, does the fee stay the same each year you hold the ETF when you purchase, or does it fluctuate? That is a fantastic question, Anna, and not enough people ask this question. What happens to the fee after I buy it? Now, the way it works in Australia is that when you have an ETF like this one, you have to issue what's called a PDS. So if we go, if we even just use, say, Vanguard's example, and we come to the resources page, we can see that there's a product disclosure statement, or PDF. And in this, it spells out all the fees, some of the risks, the performance warnings, all of those types of boring things that you should read. So I'm saying they're boring, but you should read them, especially if you're going to invest in it for the long term. Now, what happens is when they set the fee that you see when you go onto their website, that's automatically deducted, but it can change. And so what happens, Anna, and what I implore everyone to do if they're thinking about ETFs for the next 20 years, is not just think, oh, how much are the fees today, but how much could the fees be in the next 20 years? And the reality is the fees don't change that often. Many of the ETF fees are coming down in Australia. But one of the big things that we've noticed in recent years is companies like Vanguard, this one right here, this company right here, is actually lowering the fees over time. So that's slowly coming down with some fees on some of its ETFs. Not all of its ETFs, but some of them. And so the fees are actually falling. So Anup asked a question, is the management fee such a big deal if we are buying the high growth fund at a growth stage? And so fees do matter. So Zoan asked, do we pay the fee each year? The fee automatically comes out. So it automatically comes out. And so you have to consider that, that it's automatically coming out. You don't necessarily pay it once a year, it automatically adjusts. And so Anup asks, is the management fee such a big deal if we are buying the high growth fund at a growth stage? I think the Barefoot Investor, Anup, has a really good quote on this. And he basically says that fees are one of the only things that you can control in investing. So you may as well try and control it to your advantage. So try and pick the funds that have a lower fee, because over time, fees do have a big impact. Now, they're not the only thing to consider. I agree with you. They're not the only thing to consider, but they are one of the major things. So HCB00 asked a similar question on the fees. Owen, when you say the fee is automatically taken out each year, do you mean it is automatically taken out of the share price? Yeah, so that's the thing. So it's automatically adjusted. So it's automatically adjusted by the ETF provider. So you don't have to necessarily worry about, is SelfWealth going to take 0.49% of my money today or anything like that? So yes, Gilly, I can definitely do that. Oh, sorry. Zoan asks, what I meant is the fee taken out from the distribution too. Zoan asks, is the fee taken out from the distribution too? So the distribution is a separate thing altogether, Zoan. So that's paid separately. The fees are taken out separately. So that's a great question. Gilly asks, we're getting some great questions coming through, so I'm trying to keep up. Can you talk about the role of market makers inside ETFs? All right, I'll save that one for the end, Gilly, because that one's a more technical one, which we might people might think this is boring when we get to that question. So Amit says, isn't the fee over and above the underlying ETFs for the ETFs investing in other ETFs? Great question. I guess it depends on which ETF, which diversified ETF you're investing in. I'd encourage you to go and read the BetaShares. There's a full document on how the fees are calculated for diversified ETFs and so on and so forth. Well, we've got some great questions coming through. Okay, so I've got to get through to some more ETFs here. So we've got DZZ ETF. We put that on a list. We put FAIR on our watch list. We've put ETHI on our watch list. One of the final things that I want to explain to you guys is basically how do the ETFs come together from an ethical perspective. So before I said to you that ethical investing is about your personal principles, whereas maybe like socially conscious investing or ethically aware, maybe some of those different phrases, they're typically put together from other ETFs. The way ETFs are constructed really matters. Really matters. So for example, and particularly in the ethical side of things. So we can see here, Vanguard has this VESG ETF, and it has a goal in mind. The Vanguard Ethically Conscious International Shares ETF seeks to track the return of the FTSE Developed Market ex-Australia Choice Index. Okay, so what does that actually mean? The ETF provides exposure to many of the world's largest companies listed in major developed countries. It offers low-cost access to a broadly diversified range of securities that excludes companies with significant business activities involved in fossil fuels, nuclear power, alcohol, tobacco, gambling, weapons, adult entertainment, and conduct-related screen based on severe controversies. So this is basically saying we're going to avoid, heavy mining companies, companies involved in nuclear power, that create alcohol or tobacco, that are involved in gaming and gambling and weapons. So this right here, guys, is what we call this is called the sin stocks, the list of stocks or industries that most people tend to avoid if they have the choice. Now, I'm not saying that everyone does that, but it's what most people tend to avoid. If you have a list of companies involved in things, chances are you might exclude companies. And that exclusion process is called a negative screen. So it's negative because it's saying, I do not want to invest in that. That's a negative screen. We can also have positive screens, which is where an ETF targets investing in certain industries like renewable energy and so on and so forth. So an ETF that is like that, the VanEck Global Clean Energy ETF, is one ETF that's relatively new. And this ETF targets clean energy as part of its kind of process. So instead of Vanguard here saying that we avoid certain industries, the clean energy ETF actually targets specific industries. So I hope that makes sense. So this would be a positive screen. This would be a negative screen. The negative screen is more popular, but the positive screen is a bit harder to do, but it all comes back to what does the actual ETF invest in? And remember, one of the things that you can do to make sure the ETF is not taking you for a ride is you can come in here and you can say, okay, this looks like a great thing. I do not want to invest in nuclear power or fossil fuels and all that sort of stuff. So how do you check to make sure that they're actually doing what they say? Well, you can come in, and I don't know exactly where it is for this one, but you can come in and you can actually see what's inside the portfolio. So if we come down, we come right down on the page, and we can see that this ETF invests in Apple, Microsoft, Amazon, Facebook, Tesla. Imagine if there was the world's biggest nuclear power company in there, and yet it says that it doesn't invest in nuclear power. This is exactly how you can check what the ETF is invested in and if it is actually living up to its name. I noticed someone before said I need to pick an ethical super as well. Well, if you do that, before you switch, go and check to see what's inside the portfolio. Go and see what the super fund is actually investing in. That should be available on their website to see if they are indeed actually ethical. You know, I think the two biggest ethical funds in Australia have different opinions on what is ethical. One of them says bank shares are okay, and the other one says it's not okay to invest in bank shares. So, I mean, that's where it's got to come up. You've got to come in with your opinion on what you think is right. So just to recap what we've gone over, I'm sorry I've gone over time, and I'm sorry I didn't get to all of your questions. The first thing is that we want to invest in companies because they make us feel better, so we align with our personal values. So if we've got some sort of ETF that we think, okay, that aligns with our principles for investment, well, we can go and invest in that. And the way we can do that is we can use the widget on SelfWealth for companies, or we can use ETFs if we want to do that instead, if we want to use ETFs. Anna says, do you need to be set up for international trading to buy ETFs with international holdings? No, you do not, Anna. You can just come on and you can look at, say, like the ethical ETF here. This invests in global companies, but it's listed on the ASX. You see the Australian flag here? That means you don't have to. So Sunda says, VESG invests in companies like Facebook. While some of these companies might score okay on ESG, they might not rank very high for the ethical scale. Fantastic point, Sunda. Fantastic example. Many people have said for years that Facebook is an unethical company. Disclosure, I own the shares. So maybe I don't know what that says about me, but you get the idea. So Facebook, you might say, well, Facebook's unethical. I don't want to be invested in that. Well, then you might go and find another ethical ETF when you do your research. So we talked about what is an ETF and how it is a basket of things. We talked about what is ethical investing. Ethical investing is personal, but where is it? Ethical investing is personal, whereas sustainability and sustainable investing, you can measure the impact through carbon. Remember the chart here on the right-hand side, the positive impact of investing in, like a ethical super or sustainable super versus a non-sustainable option. Angel asks, would you consider the DZZF ETF a growth ETF? It's a diversified ETF, Angel, so it invests across both bonds and shares, but it's definitely a higher risk ETF. It is definitely higher risk because it has more shares than bonds. But the DBB ETF is a more balanced portfolio. It has 50-50, half bonds, half shares. So that's a more balanced, lower risk. And then there's a conservative one as well, so keep that in mind. Then we talked about the scope emissions. So Scope 1 is when a company controls its own emissions, like in its office and so much things. The other thing is Scope 2 is basically like, where do you get electricity? How do you control things that you don't produce but you actually kind of need for your business? Scope 3 is, how do you impact your partners, your suppliers, and your customers to also be greener? So there was one final question here, which was from Gilly Monster, which I'll answer now. This is a slightly more technical question, so I'm sorry if I lose some of you. Okay, so here we go. We're going to talk about this. So how does an ETF actually work? When I click buy on an ETF right here, what happens is, behind the scenes, there are two companies at play. The first company is BetaShares. I'm buying the BetaShares ETF, so I want to invest in their fund. BetaShares, what they do when I click buy is they don't do it at the time that I click buy, they do it each day. What they say is, every day on their website, they'll issue the shares that are inside the E200 ETF. So you can go on the website and see which shares are in there. And that list is given to someone called a market maker. A market maker is then the company that goes and buys all 200 and then sends them to BetaShares and gets paid and gives them to BetaShares in order, and it gets paid throughout the way, but it's a bit complicated. But basically, it effectively gives those to BetaShares, and BetaShares swaps the units with you. And so the way it works is, for example, if I was to buy shares in the BetaShares E200 ETF at $124.68, that's the price that I would pay. So then the E200 ETF would appear in my SelfWealth portfolio down the left-hand side here. But what happens behind the scenes is the market maker goes and buys all of the 200 shares that are included inside the ETF and then gives them to BetaShares. And then, so why does that company do that? Well, the company does that because what it actually does is it makes a tiny, tiny, tiny little profit every time it does it. It goes and buys those 200 shares and gives them to BetaShares. And every time it does that, it makes a tiny, tiny, tiny profit. And basically the difference that tiny profit they make is, in some ways, just bear with me, I'm being very simplistic here, is the difference between these two prices. The difference between the offer price and the bid price is basically, depending on if you're buying or selling and depending on the market, could be the profit or loss that the market maker makes. So great question, very technical, and there's a lot more to it than what I just explained. But if you only remember one thing from this very technical final question, is you want the distance between these two numbers, between the bid and the offer, to be as small as possible. So you can see here it's only 8 cents difference between these two. But if we went to one of the new small ETFs, so say like E200, which is a good ETF, but it's just very small, you can see this one's only 5 now, but earlier on, I believe it was a bit different. So you want the distance between these two to be minimal. Why? Because that's the way that you get in and you get out. If I want to sell, I have to sell at $24.22. And if I want to buy, I have to buy it at $24.27. So that's what we call the spread. That's what we call the spread. Now, that is a very technical way to end the day. I hope I didn't lose you there. But basically, we've talked about ETF investing using that widget on SelfWealth. Rob's told me before the show kicked off today that it's really important to remember that you can invest in ETFs for free, like free brokerage until the end of the year. So if you're going to buy an ETF, now's probably the time to consider doing that. Also, remember that it only applies to buys. It doesn't apply to sells. So keep that in mind. Amit asks, does an ethical ETF return dividends? If it's an ETF that includes dividends or distributions, as they're called in ETFs, then sure. It doesn't make a difference if it's ethical or not. They still have the same rules still apply. So you can still target ETFs or ethical ETFs that focus on yield or income as well as growth. So you can do both. We talked about a lot, and boy, was it a lot. There's a lot to fit in there. I think that ethical investing is here to stay, and I personally believe that it will be the single most important thing that happens over the next, to investing over the next 20 years. I think the way that we vote with our wallets is going to fundamentally change the way businesses operate globally. I think investing our money, not as individuals, but as one big society, will fundamentally change how businesses respect the environment, their employees, and their communities around them. And I think that there's more of this on the way. So I'm really excited to see where this industry goes over the next few years. Already, tens of billions of dollars every month is being invested into ESG-focused strategies globally. Tens of billions of dollars every month. More than $1 trillion is invested in this way. And so this is not just some small little thing like, do I buy this ETF over that ETF, or semiconductors coming, and are they going? This is a big thing, and it's going to impact the way we operate as investors for a very long time. So I'm glad you could join me for this session. This is a very quick session. There's another webinar that Rob put in the chat. Please go check that out. I actually learned a lot listening to that. That involves some experts on how they measure ESG characteristics. So thank you so much. Apollo said, shout out to whoever made the decision to remove the gigantic SelfWealth overlay. It looks so much better now. It does. Look at this thing up the top here. It's so good. You can see that? That's from Rob. That's Rob's handiwork. So yeah, we have him to thank. Yeah, it's wonderful. So thank you everyone who joined us today. I know you're going to have so many questions. If you want us to do another session on this, please let us know. Just write into us, just comment below. We've got a lot to go on. There's so many ETFs you can think about. Yeah, Jonesy says, see you later. Good luck at the races. Yep, I'm not a gambling man myself, but if for anyone that is, remember the phrase, gamble responsibly. I believe that's what they all have to put in their ads. So yeah. Jacinda says, yes, please, more sessions. Yeah, wonderful. Jacinda, if you want to, remember, you can go and subscribe and get all of the different videos we've done in the past. There was a couple more a few weeks ago. Zoan says, yes, more ESG talk, please. Well, sure, why not? Okay, I'm over time. I'm rambling. It's 12 past 1. Have a wonderful Monday. Enjoy your day. And, as they say in investing, onwards and upwards.